What is going on, guys? Nick here, back with another video. Intel stock had one of its worst trading days in a while, dropping 12% in a single day after the new CEO Pat Gelsinger announced a new strategy that made investors a little nervous. The company's traded mostly sideways for the past 3 years, but even with all of this trouble, the company's still one of the largest chip producers on the globe. So I thought I would take a look at the question, is Intel stock too cheap to ignore? So Intel reported its third quarter earnings on Friday, October 22nd. Side note, beware of Friday earnings releases. A lot of times companies, when they have bad earnings to report, put them out on Friday because they know over the weekend people will forget about it. There was actually a study published in 2009 that found that earnings reports released on Friday tend to be worse, but the stocks tend to be less impacted because investors aren't paying as much attention. Okay, back to Intel. Intel's earnings weren't quite what analysts expected. They blamed an industry-wide component shortage for causing shortages in its PC chip business. They ended up earning $18.1 billion versus $18.24 expected, but earnings did come in at $1.71 versus $1.11 expected. Intel's largest business, chip computing, was down 2% compared to last year. This includes PC chip revenue, which was held back by lower laptop sales volume, since it's pretty hard to build a laptop without chips. Keep in mind that Intel might have the CPUs they need to build laptops, but there's more chips in computers than just that. Your Wi-Fi requires a chip, your LCD screen requires one too, and if you don't have one of those, you can't build a laptop, unless you want to build a laptop without Wi-Fi or a screen. The plan announced by the new CEO is to shift its business model to manufacture or fabricate for other chip designers while continuing design and fabricate its own processors. But building semiconductor factories is an extremely slow and expensive task. Taking a few years and spending $3 to $4 billion is pretty common. Recently, Taiwan Semiconductor spent $9.3 billion to build a 300mm wafer manufacturing facility in Taiwan. But the reason why Intel is making this huge investment is because they expect the semiconductor industry, which is currently around $500 billion in annual sales worldwide, to double over the next 10 years to $1 trillion. Now, Intel has really struggled over the past couple of years. They've struggled with the 10nm transistor chips, while Taiwan Semiconductor and Samsung are both producing 7nm chips at volume. And this has led to AMD's resurgence under Dr. Lisa Su over the past 10 years, as they've been able to design and Taiwan Semiconductor has been able to produce the 7nm transistor chips. Intel had a lot of trouble just trying to design and develop 10nm chips. The first 10nm chip was called Cannon Lake, and it was originally planned for launch in 2016, but it didn't end up coming out until 2 years later in 2018, and this chip was disappointing. They never sold the chip at volume, and it was discontinued by May 2020. The next generation, Tiger Lake, launched in September 2020 on 10nm transistors. After the former director of process architecture, Mark Bohr, retired, he said the 10nm technology was too aggressive packing transistors on its semiconductor wafers. But while Intel has struggled to make these 10nm chips, Taiwan Semiconductor has moved its focus towards developing 5nm chips, moving further ahead of Intel. As of last year, there was a lot of talk about Intel, who, unlike most other chip makers, designs and fabricates its own chips, for Intel to contract out its fabrication to other companies such as Taiwan Semiconductor. Intel's chip fabrication has historically been one of its strengths, keeping them ahead of their competitors. So when Intel CEO Bob Swain was replaced by Pat Gelsinger, who's a former Intel engineer and also served as the first chief technology officer of Intel, Gelsinger announced Intel would outsource some of its production to Taiwan Semiconductor and Samsung and focus on returning Intel to a leader in chip design by 2025. Also by choosing Gelsinger, a former engineer who helped pioneer some of Intel's earliest innovations in the 80s, to replace Bob Swain, who prior to becoming CEO was Intel's chief financial officer, it shows Intel wasn't taking for granted its previous strength and dominance in the chip business, and it wants somebody who really understands the business and innovation in their chip business, not unlike what AMD did by choosing Dr. Lisa Su. Okay, so now that we understand a little bit about what's going on with the business, let's take a look at how they're actually performing. So looking at their revenue and net income chart, we can see Intel wasn't actually showing much growth in revenue and net income between 2011 and 2015. And then in 2016, sales started to pick up. We also see in 2018, profits jumped to an all-time high, but since then, revenue has continued to grow, but profits have actually shrunk. We can see when we look at their revenue versus expenses, they actually do a pretty good job keeping costs proportional to the revenue as it changes. When we look at their individual segments, we can see the business is made up mostly of their client computing segment, which are mostly sales for PC chips. And the other big segment is their data center business, which are their optimized platforms related to products designed for cloud service providers and big data using organizations. While both of these segments show a lot of profit margin, neither are showing impressive growth, and the data center business is actually showing a pretty big drop off in income. Okay, so now that we have an idea of how the business is performing, let's take a look at what it should be worth. Looking at their forecasted revenue and earnings, growth again here isn't great, and the current forecast for 2023's revenue and net income are pretty much in line with what we see today. $77 billion in revenue and $18 billion in net income. The revenue growth chart here pretty much shows the exact same picture, and when we look at net income growth, we again see more of the same. So I think for Intel, we have to use a growth rate of 0% for the bottom end valuation, and for the top end, let's just pretend that the new CEO gets things together and somehow they get to 5% growth. But keep in mind that this is all a major if, so a 0% growth rate gives us a fair PE ratio of 8, and our top end estimate of 5% comes out to 14. Now, when we look at these forward earnings estimates multiplied by their fair PE ratios, we can see what we're projecting the stock to be worth in the future. So the orange line on this chart is our stock price, and the blue line is our top end estimate, and the green is our bottom end estimate. This puts Intel at almost exactly fair value at $50 per share right now, with the top end estimate showing 65 and the bottom end valuation showing 37. So I don't currently own any Intel stock, and I don't necessarily plan to buy any anytime soon. Now, I really like the idea of having somebody who's actually an expert in their products running the business, but I think it's going to be years before it starts to pay off. If you go back to 2015 and you look at when AMD was taken over by Lisa Su, it's kind of like the same situation. Now, it paid off huge for AMD when they made the switch, even though in the short term their profits did take a big hit at first. So I'm going to keep my eyes out for signs that Intel's finally getting it together, because I do think that if Intel starts to refocus and starts to return to what they used to be, the stock's going to rise really fast. However, as of today, analysts currently don't see this happening yet. Now, I think that you should check out this great video that I have right over here, but make sure you hit the like button before you leave, and as always, thanks for watching.